Hi everyone, it's Professor Reiko here again today, starting our videos on the investments chapter portion of your intermediate accounting. So when you think about investments, a lot of times people think from an individual standpoint that they might invest in another company. Well, companies are no different. They also invest in other companies. So what are some reasons that when you think about why would a company invest in another company? Well, from the if you think about just from your personal point of view, why would you invest? Well, that one of the main reasons is same for a company. That is, you want to earn a return, right? You want to earn a return on your investment. So this could be in the form of a dividend if you're investing in a dividend-paying stock, uh, or you could just be holding a stock, wanting it to go up in value, and then sell it for a profit, which we call capital gains. And you could also invest in bonds. And when you invest in bonds, you're going to earn interest on that investment. So those are all different ways to earn a return. So companies can do that as well. Another reason, and this is probably more for companies because usually as individuals we can't purchase enough to have this, but another reason would be control. Right? If we purchase enough shares as a company of another company, that gives us influence over there. If you think about common shareholders get a vote, and each vote, they can put more people on the board of directors that share their views and so forth. All right, so there are two main ways to raise capital. All right, and we call that debt capital here and equity capital. So when we say issue debt, mainly we're talking about bonds. At least that's kind of what we'll focus on. And we say issue equity, we're talking about issuing stock. All right, so when we do that, when we issue debt or issue bonds, which we'll cover in the long-term liabilities lessons, and when we issue equity or stock, which we'll cover in the equity lessons, both of those see an inflow of cash. We issue the bonds, we get cash. We issue the stock, we get cash. Now, there's other things you could get besides cash, but the majority of the time you're getting cash. All right. So in this chapter, we are the company buying the debt or equity. All right. So in the other chapters that I just mentioned, we will cover us as the company issuing bonds and issuing stock. In this chapter, we're the company that's buying these bonds or stock. All right. So we are the investor in this chapter. All right. So when we talk about debt securities, all right, so meaning bonds, all right. So when we talk about debt securities, we're thinking about issuing bonds. All right, so it represents a creditor relationship with another entity, and we break these into three main categories. All right, so if you can see them, they're listed here. Held to maturity is the first one, trading securities is the second one, and available for sale is the third. All right, so if you look up here for held to maturity, all right, the company has the intent and the ability to hold the security to maturity. All right, so remember if you go and look through the bond issue lessons, you'll see that when we issue bonds, bonds typically have, a 10-year life, 20-year life, whatever the case may be, but they have a maturity date when they mature. All right. So we believe, and when we classify them as held to maturity, that we will hold them to that point. All right. So if you look at all three of these here, notice they have an A, B, and C. All right. So notice the A portion is how do we value them on the balance sheet. Okay, the B portion is what do we do with unrealized holding gains and losses, and the C portion is what do we do with the interest as we earn it, and what do we do with a gain or loss when we sell it. All right, so let's just take each one of these individually. All right, so for held to maturity, this one's a little bit different than the other two. We're going to value this at amortized cost. So notice the definition here of amortized cost. It's the acquisition cost, meaning what we paid to buy the bonds, adjusted for any amortization of a discount or a premium. Okay, we'll get to all that in a little bit. All right, unrealized holding gains and losses are not recognized. So are not recognized. So what does that mean? So an unrealized holding gain or loss. All right. So what that is if let's say we're holding a bond and we purchase it for $100. All right. And let's just say there's no discount or premium. But there's an active bond market just like there's an active stock market. So let's say at the end of when we're on a balance sheet date, the bonds are now worth $120 instead of 100. So that means it's gone up in value 20. All right, so we would call that an unrealized holding gain of 20. All right, the key word there is unrealized. All right, so remember, when you actually sell it, we have a realized gain or loss. All right, so anyway, so what we're saying here is the change in value, whether it goes up or down, is not recognized, so it's not relevant. And if you think about it, that makes sense, right? We're not concerned with the change in value because we plan on holding this bond to maturity, so we're not ever going to sell it anyway. All right, so the fair market value isn't that relevant to us. And then C, and if you'll notice, C is going to be the same for all three. We will recognize interest revenue when it's earned, and we will have a gain. We'll record the actual realized gain or loss if we do sell it. All right, trading securities are our short-term ones. These are bought and held for sale in near term to generate income for the company. All right, so we're dealing with hours and days as opposed to years for held to maturity. All right, so notice the big difference here. Valued at fair value. All right, that means we do care about the change in value. Okay, so that means on every balance sheet date, we're going to adjust whatever the value of the bonds on our books are. We're going to bump that up or down to the fair market value to record on the balance sheet. We do this by recognizing unrealized holding gains and losses. So here we are going to record unrealized holding gains and losses each period. And notice here they are recognized in net income. And then C, once again, is the same. We're going to recognize interest revenue when it's earned and a gain or loss at the sale. All right, so available for sale is kind of our catch-off. It doesn't fall into one of the other two categories. Notice the similarities here. Valued at fair value, so that's the same as trading. Our only main difference is we are going to recognize holding gains and losses. Unrealized holding gains and losses. But we're going to do this as other comprehensive income. All right, so we don't put them into net income. We're going to put them into other comprehensive income. And then C, once again, is the same. We're going to recognize interest when earned and a gain or loss at sale. All right, so how do we go about accounting for this? We are going to use the effective interest method. So if you did, it depends really on which book you're using. If you're using the KESO book, the bond issue chapter comes before investments. If you're using the Spiceland book, investments comes before. So either way, just make sure you're familiar with the effective interest method. But it's covered in both, and I will cover it in both series of videos on the different chapters. All right, so effective interest method, that we're going to use that to compute interest revenue, the amortization amounts, and amortized cost. And amortized cost, remember, if you look back up for the held to maturity, let me scroll back up, and you see it's up here. It is valued at amortized cost. Okay, amortized cost will be the far right column of the amortization table when we start doing those. All right, so this is just kind of our brief introduction into debt investments. So in this chapter, looking forward, we're going to go through now these three types of debt investments and how to account for them, record the unrealized holding gains and losses if needed, how we handle them when we sell, and so forth. And then we'll switch gears and go to the equity portion of the chapter and cover issuing stock. Cover the purchase of stock and how we account for that as an investor. All right, so once again, I hope you're enjoying these videos. Please, share it with your friends that might be in class with you, and hopefully this is a good supplement to what you're already getting in class. I hope you're enjoying them. Please subscribe to my channel and tune in next time.